welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Today, capital gains tax. By offering a lower tax on money made from capital gains, does that mean people invest more in growth for the economy? Or does it in fact make no difference whatsoever? That's today on the Debunking Economics podcast. So, Steve, there is a theory in many conventional government and economic circles that if we lower capital gains tax, then we are going to increase investment. By taxing capital gains at less than income tax, it encourages risk-taking and entrepreneurship, which spurs economic growth. But there's another argument that it simply creates loopholes for tax avoidance schemes for the wealthy. I suspect I know which side you're going to jump on this one, but Just tell us. Just put us out of our misery.
I hate to disappoint you, mate, but you're right. You do know which side I'm going to jump on. It's bloody tax evasion.
So, I mean, okay, but this argument, why is this argument so wrong then? Look, if you lower capital gains, that means I am going to be more prepared to use my money to invest in things that are going to create money for the economy.
Well, what it's actually ended up being is investing things that create money for the economy in the finance sector. And this is the mistake, because all we do is increase the price of a house. Now, if the price of a house doubles, that doesn't mean the workers and children inside are twice as productive. It's something you just inflated the bloody value of the capital. Right,
but you're talking about houses. Let's put housing to one side. What about I'm investing it in equities that are, the newly issued capital for companies, for example? I have a wonderful family, and one of my brothers-in-law I'd happily have had as a brother. Very, very genuine, sincere guy. And he and his wife my sister obviously, were deciding to set up their own, what they call self-managed superannuation fund in Australia, which is a pension fund that you decide what you invest in yourself rather than having it done by a third party. And he was very, very earnestly saying that they decided to buy Cochlear shares, because Cochlear, which is an Australian company, had invented a means of wiring a hearing device into the cranium so that you could actually give somebody who had no hearing at all, give them hearing. Actually, complete replacement for the ear system. And he was so inspired by this. He said, well, we want to buy Cochlear shares and support that work. And I didn't have the heart to tell him that when he bought Cochlear, not a single ruddy cent went to Cochlear. The shares were sold to him by another speculator. Yeah, okay. But companies starting out need money. They need capital. So when you look at, initial public offerings, for example, they are riskier. Because you don't know which way that company's going to go. And couldn't people say, well, okay, that's a risk I'm prepared to take if I know that I'm not going to get hit with huge capital gains tax on the return if it does well, because I'm taking a risk on it. That
itself is a better way to go. You have to say what sort of, when you say capital gains tax, what sort of gains are you talking about? And if it's a case of giving money to a company, which then uses that money to invest and then generates a new product, which takes over an industry or develops a new one and makes profit out of that. That's the sort of capital gain you want. When you give it to people who buy and sell shares of each other, or sell houses as well, which, that's where the capital gains exemptions generally speaking end up. It just inflates the price of the bloody asset and does nothing at all for the productivity of the economy. So I'm a critic. I mean, it's been incredibly damaging in Australia in particular. You and I have seen a fair bit of that when we were there.
Yeah. House
prices and share prices, and equally in America, the same story. When you put a lower tax on share market speculation, well, whoopee-doo, you encourage more share market speculation.
Well, in Australia, of course, I don't know if it's still the case now, but it was a couple of years ago, and it had been forever until that point. The capital gains tax on returns on a house was half the amount of ordinary capital gains. So there was every incentive, if you were going to invest your money, to put it into housing rather than into companies, because you were going to get less capital gains tax at the end of it all, which is...
insanely bad idea. But of course, very popular with people when you first do it, because people are trying to get an increase in their equity, and bang, here's a way of doing it and getting a tax gain out of it. So it's far better for you to fall asleep in a house and watch the price rise than just to go and work.
So, what if you just got rid of capital gains tax then?
we'll go back and address that issue about, maybe it should be applied where it's actually creating growth. But if you just got rid of capital gains tax and said, well, okay, if you're making money, doesn't matter where it's come from, whether it's money from you going and doing your day job or it's a gain you've made. Why not just treat it as ordinary taxable income? Perhaps you could spread it, if it is a payout, you could spread it out over a couple of years or a few years if that seems fairer. That makes a lot of sense. It's just called income tax, isn't it? It doesn't make any difference what the income is. Would that be a fairer system, and how would that change behaviour, do you think?
That'd be better for us than what we've let ourselves get caught up in, without a doubt. Right. Because this has all become a rort for the wealthy to avoid taxation liabilities. And then what's happened, of course, again, because I don't believe that the taxation funds government expenditure, but what it has meant is that the amount of money being pumped into the economy by the government is then, when they siphon the money back out again to stop the money supply growing too rapidly and causing monetary inflation in the economy, it's being siphoned off the working class and the middle class and not off the wealthy. And so a large part of the accumulation of the wealthy is because they've evaded the removal of the tax revenue from them that should have been taken out of them. And by halving the rate of capital gains tax and all the other tricks that people have done, it's making them even better off and increasing the inequality in the system as a whole, which, of course, is what's leading to yellow vests around the world.
Absolutely. Although, on the other side, there are people who argue that capital gains tax should be done away with in total. That, that in effect is a double tax, because basically capital gains is a tax. Take a company that's doing particularly well. It's paying tax on its profits. As a result of it doing well, somebody sells their shares that are now worth more. That's a capital gain. They're worth more because the company has been doing well. The company has already paid tax on doing well, and now you're paying capital gains tax on the returns because the company's doing well. They say that's a double tax hit on growth.
Yeah, well, and of course, we were talking about Australia earlier and how much it went for giving, halving the rate of capital gains tax and so on. It's also fallen for that argument as well with what is a dividend imputation scheme. So you can, if a company pays tax on its profits and then pays dividends out of the post-tax profits in Australia, the person getting those dividends gets an imputed tax benefit, which they can use against their other tax claims. So it's this whole fairness thing comes out in their favour. The trouble is, it ain't fair, because to own shares in the first place, you've got to be wealthy. Yeah. All the stuff about being in a capitalist democracy on this front, and workers own shares through their pension funds. Garbage. By far, the vast majority of share ownership, even through things like superannuation schemes and pension schemes, is by the wealthy, not by the poor. So this is, in a sense, you're being fair to the rich, but you're not being fair to the poor. And so in that sense, I'd rather say, look, just wear it. If you're wealthy enough to own shares, you might be hit by a double tax on that system. Well, but at the same time, the companies have been moving their income statements offshore, so they make their money in the Cayman Islands.
Yeah, which gets back to the argument about whether you actually should get rid of corporate tax altogether and just tax all income, so the individual pays. The company.
No, that'd be worse.
Well, I mean, it would mean that not if the tax system is applied. It would mean it would be a very progressive tax system. You'd basically have very high rates at the top end, which of course no one would be very happy about, because it would be well over 50%. It would be like 70 or 80% tax, and people get upset about that sort of thing.
And you can't. That's why you can't do it. And this is why what's his name? Sugar. That the charming, polite, upper class twit in England at the moment, who's attacking people for being jealous of his income.
Well, take anyone in the Conservative Party, but you might be talking about Jacob Rees-Mogg, are you?
There you go. That'll do. Now that attitude is where tax evasion comes from, and then with the ultimate end of tax evasion is people you can only evade tax if you can afford to pay the accountants for it. Therefore, the wealthy benefit. So it got to be absurd at various times as well. I mean, back in the days when you did have progressive taxation in the UK, the Beatles were paying 99% on their last few dollars, and that's why wealthy performers started moving to places like the Macau and so on, and what's it called, Monaco. Pardon me. Yeah. So I think that's ineffective as well. You have to get around this hassle. You've got to be putting the taxes in a way in which they are seen as socially socially neutral and that nobody can really complain about them. And I'm ultimately in favour of, I don't know how to design it, but I would be more in favour of transaction taxes, because transactions taxes be paid by the corporations involved in the transactions, not by the individuals. I think I can understand where income tax initially came from, because it was actually initiated largely to in response to the war years. Now, in the war itself, you've got enormous amounts of government expenditure, which are financed by issuing bonds, which can only be purchased by the central bank, but are purchased by the population in the first instance. But that pressure means you generate a huge amount of money in the economy, and you tax to take the money out of circulation. Income tax is one easy way to go about doing that. It was simple. But now I think the social and the institutional impact of that, so income tax, has led to the awful world we're in these days. And I would rather go, let's just try to work out how to do the same thing by doing it on a per transaction basis, which corporations can't pretend they're making the transactions in the Cayman Islands when they're selling something to you in Waterloo. And we can actually stop all this evasion as well, which is putting an extra burden on the working and middle classes, who end up being the ones who revolt against the state.
Well, there is a lot more to this discussion on capital gains tax. If you want to hear it in full, then you need to subscribe at debunkingeconomics.com. Choose one of the subscription options in the right-hand column, or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. If you pledge $10 or more per month to support his work in economics, then you get access to this and all the other podcasts in this series. I'm Phil Dobbie. Thanks for listening. We'll see you back here with Professor Steve Keen next time.